Everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Another weird week with respect to news and just a major disruption. Clearly, everyone knows what's going on with the hurricane over on the East Coast here. Again, today is Friday, the 6th of September. Basically, everybody should be back in school. So I guess all across the country now, kids are back in school the first week. I guess you could say the summer selling season is officially over, as far as I'm concerned. And let's get to some news. Now, obviously, for me, the past week was kind of disruptive here. And as everybody knows, we had a major hurricane hovering around the east coast of Florida. Not very good at all. Fortunately, we dodged a big bullet here in Florida. We really did. For those of you who don't obviously live in Florida, there was a huge amount of panic with respect to this hurricane because it was tracking to hit the middle of the state. It was gaining steam big time, increasing in strength and size. And that's not a good thing for obviously Florida and the coastal regions here. It actually got to a Category 5 hurricane at one point as it hit the Bahamas. So that's unfortunate that they got decimated with that. But I think the issue was that this was the first hurricane of the season. So of course, people are panicking. You kind of got to get back into this mode like, oh, there's a big storm coming. Everybody buys water, everybody gets gas, they get supplies. Within a couple days, all the stores are bare, and we're watching this hurricane kind of, slowly make its way through to the Bahamas and eventually to hang around the coast here. So sometimes I think too much information too early is not a good thing. But again, we're prepared now for the next one that hits. And again, this was a major potential U.S. landfall issue. Obviously, schools were closed a couple days this week. People were buying supplies, going to the bank, long lineups at the gas station. So for those of you who are not from the Florida area, this is typically what goes on here first time around. But I'm noticing that every year the panic seems to be getting worse and worse. People are flipping out more. Whether that's an indication of the economy or the issues people are facing, it just seems to get worse. Maybe it's the fact that we have social media, we can talk about it, everybody gets amped up and things are out of control. So as of this morning, the hurricane has moved its way up the eastern seaboard. It avoided Florida, which is great, avoided Georgia and South Carolina. It's actually making landfall on the North Carolina coast, I think around the Cape Hatteras area, and it's making landfall as a Category 1 hurricane, which still is a hurricane, and don't get me wrong here, it's still dangerous. There's obviously higher winds. There certainly is, a storm surge and flooding. But I guess the one saving grace is not a Category 5 or something, something of that magnitude, which would really wipe out a lot of things. So again, I hope the people of North Carolina are safe and they've evacuated and they keep away from the coast and keep high and dry. Now in the Bahamas, a totally different story here. They had a day and a half of the hurricane just literally hovering over the islands there, especially on Grand Bahama, and apparently some of these islands are 70% underwater now. Tens of thousands of people are displaced. It's carnage there. It's just out of control what the damage was. I know one of the airports, I think on Grand Bahama, was underwater still with respect to the storm surge. Again, when you have 150 plus mile an hour winds battering down on you and you have an 18 to 20 foot storm surge, things get wet pretty fast. So again, the island is 70% underwater. So please, if anybody can, donate to those, efforts, that would be appreciated. They need a lot of everything there, unfortunately. So that's the way it goes. So now getting to today's news, there's just one main thing I'd like to talk about today. And yes, I have visuals. So it's a big deal when I bring out the visual effects here. So clearly, when I do these these videos, I do them in one take. I don't break it up and piece it together and have a great, we'll call it visually stunning production and things of that. Listen, I know what I'm doing. I'm not going down that path. To me, that's just extra time and effort. Sure, it may look nice. Other people do that, but I just don't. I want to do it in one take, give you the pertinent information, and you can go from there. So, the housing market, and other aspects of the economy, a lot of people look at a guy for his take on what's going on. And that guy happens to be Robert Shiller. So he hasn't spoken in a little while, and I guess it was due time that he was interviewed or had some things to say in the media. And I was actually thinking over the past couple of days going, we haven't heard a lot about, he hasn't spoken lately. We don't know what's going on, and typically, he has a lot of insight into the housing market. So, there was an article and a video on Bloomberg TV, and you can see the interview for yourself if you go into Bloomberg TV. That's, you'll watch it. But I want to give you two headlines that were out in some of the news sites today. And the reason why I want to do this is a number of reasons, and I want to make sure people understand why I'm talking about this and what's going on here. So the first headline was on Bloomberg. It says, Nobel laureate Shiller says U.S. home prices could start falling. That's the article that Bloomberg produced. And today on dsnews.com, it says Nobel laureate, housing market crash on the way. And I want to be clear here is that, I'm not making stuff up. I'm just reading and, we'll say revisiting what's been put out there by the media. So, when we speak about agendas or where the housing market's going, et cetera, I'm reporting the news. The stats, the numbers are the numbers. I can't make them up. I just report on what's produced. Well, and again, the headlines, I'm not writing these headlines either. Housing market crash on the way. So you can take that for what it's worth. So ultimately, in the end, it basically, if we take a look at what he is saying, is the article says, Nobel laureate Robert Shiller said he wouldn't be at all surprised if U.S. house prices started to decline. And essentially, the S&P Case-Shiller index for property values and the 20-city index decelerated for a 15th straight month in June, increasing just 2.1% from a year earlier. Shiller noted that adjusting for inflation, prices had already flattened out, which is kind of interesting. And it would suggest declining home prices in the near future, and I wouldn't be surprised at all if house prices started falling. That's coming from the man who created the index, which most of the economy looks at to get a litmus or a position as to where housing is going. So that is what he said right here. So again, if you take a look at other discussions and other people commenting on what he said, this was in DS News. The guy from CoreLogic basically said, and he's deputy chief economist of research at CoreLogic, said while falling mortgage rates have thus far only led to an increase in refinancing rather than purchase activity, there will undoubtedly be a large boon to the marginal home buyer. So what they're really saying is that, hey, if you're on the fences, the lower rates are going to help you purchase. Well, that's great. It doesn't make your home less affordable. It makes your payments more affordable. So I want to keep that in mind here. So, if you go to the Bloomberg TV and you take a look at his interview, which I think everybody should, you can certainly listen to what he has to say. But here's a synopsis of the minute and a half that we got on housing. So his comments were: housing is more forecastable than the stock market. It's less volatile, and what he means by that, it smooths out more. Stocks tend to go up and down a lot quicker and faster. Housing stretches out more. Momentum in housing is a strong factor in the forecasting. 2012 was the bottom of the housing market. After that, we had year over year of double-digit appreciation for a couple of years, but it started to gradually decline, more like 3% now. And in real terms, which I think is important, he says, when corrected for inflation, the appreciation is close to zero, so it's flatlined. And he said we can extrapolate this information. Home prices will decline in the near future, and he wouldn't be surprised if home prices fell, and it could accompany a recession. So, that's kind of what the guy said. So he goes on, the past few interviews, he talked about markets having some issues, things he's not quite sure of yet. I wouldn't be surprised if things happened. And now he basically is coming out right and saying, hey, home prices will be declining, and it's going to happen in the near future. Get ready for it. That's what I take away from this, which I think is interesting. So remember, this guy is the co-creator of the Case-Shiller U.S. S&P, CoreLogic, U.S. home price indicator. So he basically is the co-creator of that. He's a Nobel Peace Prize winning Yale graduate economist. So he certainly is a smart man and knows what he's doing. And the index is quite interesting, and everyone follows it. It's the index that we use to gauge housing And again, if you take a look at what he's saying, he believes housing prices will fall. I'm not making that up. I'm not putting words in his mouth. That's exactly what he said. He wouldn't be surprised if he fell. He expects a decline in house values. So I would tend to believe him on a personal note. That's what I do. Now, in other interviews that I've talked about, he has mentioned previously that before the last housing crisis, back in like 2007 and 9, when that crisis occurred, that if you actually looked a couple years earlier, you already saw the signs of the deceleration of appreciation. Things were starting to decline, and but we weren't looking for it then. That was the problem. That his index, wasn't created then. We weren't looking at those numbers, and it kind of hit us, up the side of the head for a number of different reasons. We weren't tracking it. We didn't have the same information access, and we didn't have social media and all the stuff that's going on right now to key us into what's happening in this marketplace. Well, I look at it going, we are at the top of the bubble. So for people who do not believe that we're in a housing bubble, let's take a look at it. So I made this chart here, and this is not necessarily, we'll call, in intense graphics here, but I wanted to demonstrate, what the Case-Shiller indexes show. You can look this up online. You can type in, US S&P Case-Shiller index. You're going to get various charts, graphs, whatever. But it boils down to, they started tracking this in 2002 with the index, and it shows that, in 2006 to 2007, we had the first housing bubble, which is right there. So it was called a housing bubble. It is a housing bubble, and that was the peak values of real estate at that time. So the housing, bust happened, it crashed, we fell into a crisis mode for a lot of different reasons as well, and prices decelerated, prices came down, they fell below the line. So we lost, on average, across the board, 27.4% of home value to get us to this trough, which was in 2012. All right, so this is the national composite index for Case-Shiller. Case-Shiller also has a 20 city and a 10 city. Now you'll see some different numbers here, but I want to go across the board. Okay. Now this number is actually bigger if you go to the 20 and the 10. All right, the decrease. But again, looking at almost 30% decrease from the 2006 peak. So we troughed, and then we went through some periods of growth to where we are at 2019. And as of the June statistics, which I reported on a couple of videos ago, we are now 14.1% above the 2006 peak. So I look at it going, you can see where housing bubble one hit. You can see where the trough is, and you can see where we are today. So the recovery is pretty good. The recovery is 14.1% above the 2006 bubble. So if there was a housing bubble here, is it okay to call it a housing bubble over there? I think it is, because we've done this. We've increased from the previous bubble. So so as far as I'm concerned, that's what I base my information on. That's what I base my opinions on. The fact of the matter is we've 14.1% overachieved from the last peak of housing values in the housing market. So I just look at it going, why can't we call this a housing bubble? So people who don't want to call this a housing bubble, you're free to do so. All right. But as far as I'm concerned, this proves that we are above where we were. And we know, based on the information and what he's telling us and what the numbers are showing, that price appreciation is slowing down, and he is flatlining, and he expects a decline. So we've kind of peaked with our value right now. So the signs are there. As I said, home sales are slowing down. So every month we're seeing less and less homes being sold in the marketplace. All right, all the signs are here, guys. Prices are decelerating. Prices are dropping. Some locations faster than others. Some still are eking out some increases, but those increases are slowing down. Multiple offer scenarios are becoming a thing of the past. They're being drastically reduced. Redfin, for example, basically came out a couple days ago and said, hey, reaching a historic low, only 10.4% of offers on homes written by Redfin agents in August faced a bidding war. So again, Redfin is only looking at their numbers from the markets that they're participating in on their listings or their deals. But still, they were saying before it was 60% a couple years ago, right, or last year. So now we're down to 10%. So we see that is slowing down. We know new home building volume is down significantly. There are less sales, less housing starts, less permits being pulled from the counties and the cities. Home prices are down to their lowest levels on median home price in a number of years. So we've seen that drop from the mid threes to about 310, 312, and they're dropping. All right, and that's a home price that doesn't include other incentives, because we know that builders are offering upgrades, X number of dollars worth of upgrades and finished material. If you use builders, mortgage companies and other entities that they have as related companies in the transaction, they're crediting people for closing costs and things like that. So even though median price is down, there's still other areas where builders are giving away incentives to real estate agents, to home buyers, via closing costs, whatever. So they're buying the market on another hand as well too. So prices drop, but they're also taking it over here as well. So please be aware of that. Additionally, if you want to talk a bit more about the signs here, multifamily starts have, of course, peaked this year. So multifamily has peaked, and we're actually seeing some slowdown in some multifamily starts as well too. That's multifamily units, apartment complexes, whatever. That's being used to sort of soak up the people who need to live someplace, right? If they can't rent and buy, they're going to rent. And if they can't rent single family homes because of inventory issues, they're going to multifamily. Simple as that. So multifamily starts have increased and peaked. Rental rates have hit peaks as well too, and actually have started to decline in certain locations across the country. So that market's peaked, and now we're seeing some erosion there. Something that I look at as well too, the number of real estate agents and real estate investors that come into the market during a housing boom increases. So we know that there's over 1.35 million real estate agents that are operational right now in the market. We know, now I don't know the number of real estate investors because it's really hard to track that, but we know that there's more real estate investors out in the market based on the competition, based on the number of people that are trying to flip properties, are flipping properties, et cetera, et cetera. So we know that peaks when you have a housing bubble. Everybody comes out because they think that, hey, I need to get into this market and make my money somehow, some way. All right. Investor flipping and profit is declining. So as per Adam Data Solution, the past couple quarters, we have seen flip property profit decrease. And again, they typically look at gross profitability. That's what they manage and that's what they report on, sale price versus sell price, because we don't know what it costs to rehab, what it costs to utilize money, things like that. But the point though is that profitability is going down. Reason being because acquisition prices are up, material prices on rehabs are up as well too. So people are getting squeezed there. So we're at a bubble point in that. Mortgage rates are very low. So we know that we had a higher increase in rates at this time last year. It kind of ended when it started to fall down. So the stimulus of having rate decreases is not bringing more buyers into the marketplace. That's got to tell us something. So if rates are at, again, very, very low rates right now, we're not seeing home sales increase dramatically whatsoever. Actually, we're seeing them stagnate. So, clearly mortgage rates are not our issue anymore. And even if there's a further rate decrease of 25 or 50 basis points, as per what many economists seem to feel there will be in the coming, maybe in September, at least one more, in the back half of the year, some are predicting even 2 more rate decreases, is that going to be enough to spur a huge home buying frenzy? I don't think so. Only thing that really has increased is refi. So people have refinanced, their homes, so obviously they get better rates, and typically when people refi, it's not always about rate and term, it's also about tapping into that equity. So people have tapped into the equity. As far as I'm concerned, if you're tapping the equity, you may have already felt that the market has peaked, or the chances of you selling your home at the numbers you want may have already passed you by, and that's why we're at the refi market now. This tells us that homes are too expensive. All right, when we talk to people, when we read articles and there's quotes from people, and even on this channel when people are commenting, the number one issue is that things are way too expensive, I can't afford it, or I'm not going to pay for homes at this price. So, it's really what the people are saying. It's what the public is saying, what the buyers are facing. They're not going to do that. So buyers are telling us that it's too expensive, I'm not going to engage in this anymore. So now, according, we all know, and if you start doing some analysis on this, and this is where I don't think people really want to look at the information, but we all know that home price appreciation and wage appreciation have not kept up with each other. And I've got a chart which I can produce maybe the next video or whatever, but the best time to have bought was in the trough, and it just goes to show that when the prices came down and wages went up, it kind of met in this area here. Today, the divergence is too big. Wages have gone up on a sliding scale, not an exponential scale, and that's a difference right there, everybody. So, wage increases do not match home appreciation. There's a divergence there, which means people aren't going to buy homes. Simple as that. As I said, mortgage, so it goes back to unaffordability. Mortgage applications for the past couple of weeks, after increasing based on the new lower rates, they've slowed down now. So mortgage applications have dropped from both on the purchase side, and the purchase side has been dropping for a number of weeks now. The refi side had a bit of a boom, and even the refis have dropped down now because people who probably needed to refi or could qualify have already applied. That's the way they look at that. And as far as I'm concerned, as I mentioned earlier in the video, guess where we are today? It's September the 6th. Labor Day was on Monday. People are back in school this week. The summer selling season, as far as I'm concerned, is officially over. So now we're going to have people who have their homes in the market going, what am I going to do? I didn't sell my home. What's my next move? I take it off the market, I refi, or I lower price. That's your options, and we're not going to get a bump, in the next 2 or 3 months for sure towards the end of the year of another home price appreciation wave. It's just not going to happen. Now, the government and lenders are trying to resuscitate the home buying market, the mortgage market, by offering what? Lower down payments. Of course, you can do a lot of loans that have been written recently over the past couple quarters, FHA based. Why? Because there's good rates, government back guaranteed, and also low down payment, and also higher debt to income ratios. We know a lot of these loans are over 45%, 50% debt to income ratio, which is a lot of household debt burden to take on for the average person. We have more subprime type loans being originated these days. Back in the last housing crisis, what kind of kicked it off was the subprime mortgage meltdown. So of course, what happened after that? Everything contracted, lending guidelines tightened up, and it was tougher to get loans. But as time goes on, when mortgages aren't being originated and people aren't buying homes, what happens? Guidelines loosen. So we've seen over the past couple of years, a lot of guidelines have loosened. Subprime is back. It's just called non-prime now. A lot of the lenders who used to lend, like B of A and Wells Fargo and whatever, aren't playing that marketplace, but the non-banks, right? The Rocket Mortgage, Quicken Loans, Caliber Home Loans, etc., PennyMac, those groups have now taken over, and they're offering great rates and lesser qualification standards to the next wave of home buyers, and they're grabbing those loans. Simple as that. Which means low down payment to me means more risk in the marketplace here. There's more grants and programs going on right now. So of course, if you're in a community or a lender, how are you going to increase loan volume? Well, there's an example here that I picked off today. It's Bank of America, and basically what Bank of America is doing is they're offering qualified home buyers in various locations. They're talking about Detroit right now in this article, but they can do this in apparently 50 different locations across the country, anywhere there's a Bank of America branch. They have something called the Community Homeownership Commitment Program, and it's a $5 billion commitment designed to help more than 20,000 home buyers across the country. Through the bank's down payment grant program, B of A will give, and there's no repayment necessary here, eligible buyers 3% of the home purchase price up to $10K to be used for a down payment. So now I can walk into my local Bank of America branch, get qualified. When I buy a house, they're going to actually provide the down payment. Look at that. So I've got nothing coming out of my pocket here. How great is that? Another higher risk opportunity. I can buy at the peak of the market, put nothing down. I'm not renting, I'm a homeowner now. Well, guess what? Small change in the marketplace, I'm immediately underwater. There's no risk to buyers as far as I'm concerned here. So basically, it's available in nearly 50 markets, including major metros across the country, such as Detroit, New York, LA, Boston, Washington, DC, Miami, Vegas, and Dallas. Those are places that, except for Detroit, which may be kind of expensive to live. Think about that. And also, as an extra kicker here, qualified buyers may be eligible to receive up to $7,500 towards non-recurring closing costs in some instances, or to buy down their interest rate. The $7,500 closing cost grant is available in markets where Bank of America has branches and offices, which is most of the country. So basically, if you're looking to buy a house, don't have any money, but you want to go for it, these guys are making it available for you. So for people who also talk about we're not having a housing crisis or bubble because we have higher mortgage standards, I don't know where those standards are these days. Those standards have obviously eroded, and we have no standards. So to me, this is just like going back 10 years ago, even more, and having this replay all over again. That's how I look at this. So Again, when it comes down to it, the point here is that people are buying a monthly mortgage payment. They're not buying a home. So you're looking at a home, you go, man, it seems unaffordable. But when I work out my payments, hey, maybe my payments are better than my rent. And with these neat little programs that I could possibly inquire, there's other places too. There's a group called NACA that does this as well. I spoke with that number of, a long time ago. But there's other, we'll call it lending groups that have these programs or creating these programs to get people into homes. And unlike they were doing this sort of as the housing bubble previous one was building, they're doing this at the peak now. So that's almost like, hey, let's get what we can out of this, knowing that it's going to crash. Simple as that. So having said that, foreclosure filings, which we talk about all the time here, year over year have increased in 40% of the major metro markets across the country. So not 5%, not 8%, not even 10%, 40%. So we already see issues happening in a lot of the major metros across the country. Yet at the top of the market, we're now offering a lot of people these no-risk loans. And to me, that's just like repetition of back in the old days. Simple as that. To further comment on that, we know that the banks, lenders, servicing companies, etc., are actually going to beef up and strengthen their, we'll call it, loss mitigation resources and back offices starting for the back half of 2019, which we're already in right now. What's loss mitigation? Loss mitigation is the term, typically it's a sort of a ubiquitous generic term, that's where you deal with people who aren't paying their mortgages. Whether it's a solution, loss mitigation solutions. You have a request for mortgage assistance, you fill out some paperwork and the bank your lender will deal with you on what's available. Do you want to do a deed in lieu, give the home back and walk away with a soft foreclosure? Do you want to do short sale? Do you want to do a loan modification or workout program? So there's all these things available, but they are beefing up their back offices to handle an increase in volume. And why are they doing that? Because they have the information. They have the data. So they have the data of all the non-payments of their client base before it actually hits where we can pick up the data as foreclosure filings. So they know what's going on out there. They see this. They've committed to actually increasing that because they know they're going to have to help their clients and they don't want to have these things go on like they did way before and back in the day. So again, they see the non-payment trend, simple as that. So for me, it's just like the first housing crisis happening all over again. Maybe we sort of position the pieces in a little different order, but when you actually take a look at what's happening, I think it's almost like a carbon copy, a mirror image of what was occurring back in the day. And listen, there's even more of this I can go into on certain loan vintages and we'll call it loan modifications that eventually redefault. There's all these things we could talk about that just really add fuel to the fire as to where we're at. So as far as I'm concerned, we're at the top of the market here. We're in a housing bubble. As far as Robert Shiller's concerned, we've probably peaked, and he expects home prices to decline. And he expects he's not going to be surprised what happens. So, again, he said the signs are there. We've already seen the data and extrapolate that's going to be happening here. So that's again what all I can tell you guys. And this time, but the difference though this time around, there's a couple differences. Number one is the social media aspect. So the last housing crisis, we all kind of were in our own little vacuums, our own little metro markets, kind of dealing with what's going on. Here, we have a lot more information available to us at our fingertips, a lot quicker, and we can actually see on a much larger scale what is happening and actually kind of predict and prepare for this. So I think that's a good thing. On the flip side, we talked about iBuyers and a lot more institutional investors and larger buying groups. Well, you know what? They're ready to pounce, and they're waiting for this. They don't want to buy property at the peak. So you're not going to see hedge funds on the MLS purchasing, the retail property for investment. They're not going to do that. They're waiting to buy off market, and they're waiting for the slide to happen where they can jump in and then buy at auctions and buy off the MLS when things are much lower and people become desperate. That's where they make their money doing that. They want to buy the best, that's anything, buy low, let it appreciate, cash flow, etc. So the difference though is we have a lot more of those ready to jump in this market before they figured that out in 2012. Now they're prepared for it as the market starts to tank. So, and also on a personal note, I can tell you by the number of inquiries I've received in the past, say, 4 weeks from people basically saying, how do I participate in this? How do I get in this game? Can you help us find cheaper property? What can I do to buy at a better rate? So it's just all those inquiries add up, and I'm going, people feel it. The marketplace feels it. So, please, this is all I'm telling people is that, I just look at what's being told out there, and this is what they're saying. This is, and again, from the man who is the creator of the index that we all follow, he's telling us, guys, that, home prices are declining, so get prepared for that. So anyway, guys, That's it for today. Kind of a long little discussion here, but I wanted to point out that, that for me, this is what I'm looking for. I have no agenda here. My agenda here is to buy real estate at cheaper prices. My agenda here is to help people purchase homes that are not at retail high prices that they can afford, and try to find ways to get better deals, save money, keep more money in their pockets, and enjoy their real estate purchase as opposed to stressing out over it like most people are doing. So that's simple as that. So again, if you want more information from me regarding home purchases, my programs, Never Pay Retail, my short sale program, ways to purchase discount properties, please reach out to me. Yes, I realize there's still many people I have to get back to, which we'll be doing more of that this weekend. I'll do my best to handle that and get in touch with everybody. But I really think this is what the sign we're waiting for right now, is that we're plateauing, we're flatlining. It only can go one way, and that's going to be downward now. So thanks for the views, likes, and comments. If you're not a subscriber, please help our channel grow and click that subscribe button right there on the bottom right of your video. And we'll look forward to speaking with you, since today is Friday, probably early next week. Thanks very much.